Hey guys, I think I'm live now. So if you can let me know in the comments if you can see me and hear me, that would be awesome. And remember, this is my second time to ever go live. So just trying to keep an eye out for faux pas that I might do and, all that kind of stuff. But man, it is really great to see you guys tonight. I'm excited about this. I'm looking forward to spending some time with you guys tonight and talking about valuation and maybe even a little bit about Realty Income's earnings from earlier. But at the end of the day, we want to talk about what's on your mind. And so we'll kind of just kick it around after that. And I think that'll be a lot of fun. We'll probably go about an hour unless things get really quiet. So I guess let me give a little bit of preface to this. I am looking forward to this. I have committed to be more consistent with this dividend investing YouTube channel. I think it's important. And I think, we've got a great crowd of people in this dividend investing crowd. And so, I'm looking forward to spending some time with you guys. And if I don't make it a priority, it won't happen. So going forward, you guys are a priority. So let's kind of see who's out here. I see we got Miguel. Miguel, welcome. We got Michael Swami. Welcome, Michael. It's good to see Pat here, Lucas Orr, Fast Eddie. So it's great to see you guys here. We will go ahead and get started. I think I'll ask you a question here in a little bit so that we can kind of get some involvement there. But first of all, I want to talk about valuation because I hear a lot of different things about valuation. So let me put this up on the screen. So I've removed myself there. And just to kind of point something out, is this not the ugliest thumbnail you've ever seen in your life? I think so. But anyway, it is what it is, right? So let's kind of move forward then. Things that I hear investors say about valuation, and it's really confusing because they'll say one thing and then they'll say another thing, and they are totally opposites. And so how are we as investors to think about valuation? Is it important? Does it matter? So here's one of the things I've heard. You must pay up, or you have to pay up for quality. So that's, one thing that I've heard. And then the opposite of that are folks who follow like Warren Buffett and they say, no, you must have a margin of safety, right? So paying up for quality means that you're paying a premium for your shares. I'm going to try to get me on the screen. I feel like I'm just talking to a camera. Oh, I got to find my cursor. Here we go. There I am. Hey guys. So when you say that you're paying up for quality, you're basically saying I'm going to pay a premium for the shares that I'm getting because they are high quality and they're going to give me returns in the long run. And there's nothing wrong with that. But then when somebody says, hey, you got to have a margin of safety, what they're saying is that you must buy shares when they are discounted, meaning that it's a discount. There's room for that to go until it gets back to its intrinsic value. I find those to be maybe the opposite of each other. One of the things I've heard is price is what you pay, value is what you get. And that is absolutely true. So we want to talk about that here in a little bit. Another Buffettism is it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And so I think that is good advice. Then we have success. This is Aswath Damadaran. And he says success in investing comes not from being right, but being wrong less often than everyone else. And the point about that in terms of valuation is that, a lot of people think there is a specific valuation number and that it is ironclad and that is the value of the company. That's just really not the case. I mean, the only way to know the true value of a company is to go get in your DeLorean from Back to the Future, head out 30 years into the future and look back and see the cash that was actually generated from that business. That is the only way we know the true value. We are really predicting what we think the value of the company is based on what we believe about the future. So, think of valuation more as a range, more as a neighborhood than as a specific number. At least that's the way I look at it. Got to find out where I am here. Okay. So let's move on then to this question of what is valuation. Valuation is basically, for those who may be new to investing, valuation is calculating a theoretical value of a company and its shares of stock. So for instance, if you were to go to the store, you're looking for a new pair of shoes, you would have in your mind what you believe the value of those shoes are for you. And then if you go into that store and let's say that you feel the value is $100 for that pair of shoes, let's say you buy those shoes for $120. And basically you're saying, hey, I paid a premium for these shoes based on compared to what I think the value is. But if you paid $80, you think, wow, I got a really great deal. But there may be something wrong with those shoes. They may not last as long as they had originally thought or whatever. So anyway, if you're new to investing, that's kind of what valuation is about. We're trying to do that same thing with stocks. So we're trying to get a valuation of the stock so we know what we're paying for, and are we willing to pay what the price is on the marketplace for the stock based on the value that we've calculated. So I've put a chart here on this slide, and this chart is Parker Hannifin. It's a company that I started investing in, I don't know, about a year or so ago. But it had a really interesting chart, and I thought it really helped explain what we're trying to talk about here. So if I'm going to kind of explain a couple of lines here. If I think about the intrinsic value, this comes out of Fast Graphs, by the way. The yellow line in Fast Graphs is a 15 times price earnings ratio. The blue line is what the price earnings ratio is that historically investors have wanted to pay. Neither of those really matter, but let's just assume that the intrinsic value is one of those lines. So you can see that the stock price, which is the black line, tends to go up above that and then down below it, and then it goes back up above it, it goes below it, it goes back up above it. And so the idea here is that if there is an intrinsic value of this company, shouldn't we want to buy it when it is below that intrinsic value? So I want to go to, no, let's just go to the next slide. So here's some thoughts I have on valuation. First of all, the company stock valuations are theoretical, but they matter when you're talking about growth in the long term. I want to go to something that'll help us see that here in a second, but I don't want to take the time to switch over. I'm just going to go through this, and then I'm going to switch over and do that. So then the second thing is, and I think this might be worth the price of admission tonight, which is zero. You paid nothing to be here, so it's definitely worth that. That valuation does not tell you whether to buy a stock. It tells you when you might want to buy a stock. So if a stock is overvalued, it doesn't mean that it's a bad stock. It just means that there's a lot of people that really like it and they're buying it. And if it's unfavored, then it will have a lower price. And the reason I liked to use the Parker Hannifin example is that there's really not a lot of lawsuits and things like that are associated with this. This is really probably the purest business valuation company that I could find. There's not a lot going on outside the purview of the company. So it worked out as a great example. So now let's do something real quick here. Real quick for me is probably not really quick, but I'm going to switch over then to this window here. Okay, can you guys see that? This is Realty Income. We're not going to talk about that at the moment. we're going to go into fast drafts. And this is the Parker Hannifin chart. I think this is kind of interesting. So the question is, does it matter? Does valuation really matter? And let's say that, let's say that I bought Parker Hannifin back in November of 2021, and I paid, what would that be? $334 a share for that stock. So if I bought it there, and then let's say compared to where it closed on 11/3, we see that it would have given me an 11.86% annual rate of return from November 21 to November 23. So for a 2-year period. So let's say that I waited and I bought it. Let me get rid of this one. So remember 11.86. So let's say I waited until June of 2022, it was 236. And then all of a sudden, instead of an 11% return, now I'm looking at a 48.56% rate of return per year. And basically waiting 6 months for the stock to come down. So the question is, does valuation matter? I would say absolutely it matters. There is one, and maybe I'll caption these into 2 things. One is dollar cost averaging. So if you're new to investing, dollar cost averaging is where you take the same amount of money and you invest it on a consistent basis. I would say in those cases, I wouldn't worry about valuation. Once you found out what you want to invest in, just continue to invest dollar cost average every time. And what happens is you're going to buy fewer shares when the prices are high and more shares when the prices are low. And over time, it's a kind of a no-brainer way to get a lower average cost than you would normally. And the other piece of that would be reinvested dividends. So if you've got your drip set for these dividends to get reinvested, I would say that's another time you really don't care what the price is. Just let it reinvest. So if you drip your dividends, just let it go. Don't worry about the valuation of it. But if you're starting a new position, or if you're adding a lot of shares to a certain position, from my perspective, I think the valuation really matters. I wouldn't do it if the valuation's really high. I would wait for that valuation to get more reasonable. So that's my take on this. Let me know what you guys think about this. Does valuation matter to you guys? And let me get rid of this. So, hey, I'm back. I'm back on the screen. So let's kind of go through some of the comments here at the moment. We have Miguel here, and he says, should we wait? Oh, maybe I can show that. Wow, that's cool. So he says, should we wait to buy a stock that is extremely pricey or make it dollar cost average? I would say dollar cost average is probably the better approach to that. And I wouldn't buy anything in a lump sum that might be really, really pricey at the moment. So here we got Michael. Good evening, all. Good evening, Michael. And then Miguel's back. He's talking about Costco. So Costco is a pretty pricey stock, and it has been for a while. So not really sure what to do with that because it is pricey. I don't own Costco because I just can't bring myself to pay those levels of valuation for Costco. It's a great company. It would be a great company to own. It's just a little expensive for my taste. So yes, Michael, thanks. Hit the like button. I would love it. If we could, get some likes on this, and it would give me some feedback as well, because one of the things that I want to do with this particular live stream is, first of all, get a little more comfortable with it. But secondly, I want to give it a month and see if it's something that's meaningful to you and to me. And if it is, we'll keep it going. Right. So that's kind of where I'm at. Pat is here. Good evening, Pat. And he says all is good. So we got Lucas. Lucas, hello from Canada. So Lucas is calling or joining us from Canada. So welcome, Lucas. We have Fast Eddie is in the house. Hello, Fast Eddie. Wow, Miguel. Miguel is from Portugal. So that's a long way from Alabama. So Fast Eddie says that he's freezing. Maybe I'm freezing. Are you guys encountering some freezing. And if you are, not really sure what to do about that. That might be my internet service. So Jacob, welcome. I don't know that I've seen your name before, but let me read your comment here. He says, I'm relatively new to investing. I used to use Cash App to invest $1 into the market, but I now know that wasn't a share. That is correct. So I would say, Jacob, that you might want to consider dropping some additional money into that. And I guess the way I think about it, and I've obviously been around for quite a while. So what I would say is that I guess what was helpful for me was to get my finances figured out, get my budget set, know what I needed to make in terms of a job and income. And then anything above that, I used to invest in the market. And so I would suggest, taking that approach. If you're only going to put $1 in, it's not going to grow that. I mean, the dollar might grow pretty fast, but even if it doubles, it's $2, right? So you want to kind of put a little bit more money into that. So, but we can talk about that more if you want to send me a message offline or something. Lucas, Costco, I've been taking nibbles in my retirement fund. It's been a good performer. It is a great performer. It's a great company. It's just a little expensive for me. Michael, every stock market maxim has an equal and opposite anti-maxim. That is very true. Very true, my friend. All right. So then we have Lucas. You can be wrong on some things and still be a decent investor. That's a great thing to keep in mind, because none of us are perfect, and we all have encountered some things that we wish we had done differently. And I tend to think of those as learning experiences, because I learn a lot more when I fail than when I do things well. When I do things well, I don't seem to remember it, but when I do things poorly and I fail in certain areas, I remember those a lot better. So. Oh, ex-dividend dad. Look, he's in the house. Wow. He's calling or joining us from Germany. So, or not Germany. I don't know where you are. You're in Europe somewhere. So it's great to have you here, ex-dividend dad. And that is correct. Valuation and size matters. I'm not sure, not sure where to take that, but I will just agree with you. All right, Pat, what are your 2 favorite swan stocks? So swan stock, I'm not really sure what a swan stock is. Can you let me know what that is? Is that something that I think is really going to like blow the doors off? I mean, I know what a black swan is, which is when you've got a catastrophic event, but I'm not really sure what a swan stock is. So help me out a little bit, Pat. Give me some feedback on how I should think about that. All right, Miguel, any thoughts on Estee Lauder? I have looked at Estee Lauder in the past, and it is I liked the financials. I'm not really into makeup a lot. Maybe that's a bad thing. I don't know, but it's not my forte, and I just didn't really get the vibe from the management team and stuff like that. So I kind of let it go, but it was a reasonable company to invest in. I thought it had some good promise. Gregory, wow, Gregory, welcome to the broadcast, Gregory. He says, I'm bummed I missed on SNA. I'm going to switch these screens so that I can be looking at you. There we go. How's that? That's a little better. So he says, I'm bummed I missed on SNA and V, that'd be Visa, on a lower price for a few weeks ago. So now I will have to wait to drop to a lower valuation if it ever does. And that's right. That's exactly the way we've got to look at it. We don't know that it'll ever come back down, right? I mean, you saw in the slide where we looked at Parker Hannifin. Let me see if I can get that back up. Now I've lost you all. I will get better at this when I get some experience under my belt here. But when let me do that. When I go back to Parker Hannifin, That's weird. All right, here we go. When I go back to Parker Hannifin, you know, you've got this high and this low, but the thing to notice, and let me get let me get to that. I'll get rid of these. Going to get rid of that. So the thing I want to point out here is that you got highs and lows, but the other piece of this is that companies like Parker Hannifin, who have a growing margin, growing product lines, always improving their business, their earnings tend to go up over time. And so, will it ever come back to where it was in 2021 with the pandemic? Who knows? I don't know, but it may. But as the earnings continue to grow up, to grow higher, as the earnings grow higher, then we got to realize that sometimes the stock now is worth more than what it used to be. So you just have to pick your moments, pick your battles, as they say. All right, Greg, Southern Cal here. Oh, Southern California. Wow, Greg, it's great to see you. So it's actually pretty early out there for you guys. It's about probably 5:20 in the afternoon. So Lucas says, actually, I'd like to know about Estee Lauder as well, your thoughts. So let's go ahead then, and I'm going to do this. I'm going to move my screens around. This is one of the things that I learn as I do this. Now I've got them where I need them. And let's go ahead and pull up. Let's do, just the way I would kind of look at a stock. Let's look at Estee Lauder. It's ticker symbol EL. So we'll first look at the Fast Graphs chart, and you can see that according to Fast Graphs, we can even look at it from a max perspective. We can look at it from, I tend to go to like an 8-year period of time, or you can go to 10 years. But at the end of the day, Estee Lauder seems to be pretty overvalued from Fast Graphs perspective. That doesn't mean that it is truly overvalued, but according to Fast Graphs, it is. So let's go then to my favorite website, which is Morningstar, and we will pull up Estee Lauder Companies Class A. And one of the things I like to look at here is what are they valuing it at? And they're saying the fair value is $200. So it's currently trading at 112.68. That would be as of close today. And my gosh, that's a pretty big discount. So that just goes to show you how much difference you can see in valuation from one service to another. Take a little sip. So, wow, I mean, that looks to be really undervalued. Their uncertainty level is medium. One of the things I like to look at is their economic moat. They have a wide economic moat according to Morningstar, and they have a standard capital allocation. That just means that they are basically normal, and they're at a 44% discount. So, that's not so bad. Now let's go to one of my other favorite sites, which is Simply Safe Dividends. And we see that their dividend is borderline safe. I'm not really sure why that is. So I would need to look into that further. It does say slow recovery in Asia travel retail keeps Estee Lauder's payout ratio elevated. So let's see what their payout ratio is. So I'm going to remove your comments so that folks can see this. Oh, wow. So their payout ratio in the last 12 months is now at 121% of earnings. The cash flow payout ratio is negative. That means they had negative cash flow. And then, next 12 months, it looks like they're going to have nearly 100% of the dividend be paid out that would be equal to their free cash flow, almost 100% of their free cash flow is going to be paid out in a dividend. So that is a little bit disturbing. So then, you know, if I were looking at other things, I see that they've been buying back some shares, which is good. Their sales have dipped a bit, but not terribly. I don't really understand what's driving their profitability woes. But their return on equity has dropped significantly since 2021. It was at 53%. Now it's 9%. And their return on invested capital in 2022 was 23%. Now it's 7%. So something is really going wrong at Estee Lauder. But let me take the moment then to say, you know, from a valuation perspective, it means that the valuation of this company can be seen as overvalued, right? Because and so now I understand why FastGraphs shows it as overvalued. I'm not really sure why Morningstar has it significantly undervalued. So maybe they see, you know, are looking out in the future and are deciding that hey, there's some rough road here for Estee Lauder, but maybe it's not so bad in the future. So I guess those are my thoughts. What I would do if I were going to continue researching Estee Lauder, I would actually, my preference here is to stop. When I see that, I see that there's a lot of turmoil going on. And so I think I would wait before investing in them. But if I were to take it further, I would then go to their earnings calls and I would listen to maybe one or two of those. I would, you know, bring down their slides that they would show for the earnings call. And I would even look at their last 10K and see what really is going on from a strategic perspective for them. That's what I would do. I don't know that I would invest in Estee Lauder at this point without doing some more significant due diligence on them. But, you know, if you guys have done that due diligence and you like them and you want to invest in them, hey, I don't think they're going to go away. I just don't know that their immediate future looks that rosy. All right, let's move on. Let's see. I'm not really sure where I left off, but I think it was right in here. All right, Joe, I'm glad you caught the live stream as well, my friend. Thanks for joining. And then Phil B says he missed the first 15 minutes, and it's nice to see that I'm doing videos regularly. It's nice for me as well, and thanks for that encouragement. I really appreciate it, and we'll see how they go. So Pat says sleep well at night. So that's the Swan stock. It's a sleep well at night stock. I really like Parker Hannifin as a sleep well at night stock. Let me share with you guys, I guess, where my my portfolio is. Maybe I'll share this with you. Here, first of all, I will get rid of this, and then I will present this window. Share. Okay, so those of you who don't know, I use Morningstar to track my portfolio. So one of the things that I look at, and it's got a lot of stuff here, so I will try to describe it as we move along. But so all of my stocks are in here, and even my cash positions are in here. So when I flip to the My View piece of this, I have set up 4 views. That one of them tells me about the market performance mainly for the day, but really for the week and for the month. One of them tells me, the composition, what's in my portfolio and what percentage it is. One of them shows me returns for 1 week, 1 month, 3 months, year to date, 12 months. So it gives me some information about how in the past it has done. But this is the one I want to point out, which is a valuation tab. And I have this sorted based on this column. This column is price divided by fair value. So it basically takes the current market price and it divides it by Morningstar's view of its fair value. And so any stock that is below 1 in that calculation is undervalued by definition. So for instance, Kilroy Realty is a 0.5. That means that they are trading at 50% below what Morningstar would say their intrinsic value is. So I think that's important. So, when I look at sleep well at night stocks, I think I would look at those who are kind of in the fair value range. The ones that I guess the one stock I am considering doing something with, and you can see it's IBM. IBM is trading at an 18% premium according to Morningstar. It is considered to be overvalued. So that's something that, it's not, I don't make quick moves. I think you all know that. So it's something that I've been considering over the past month or so to maybe trim some of that IBM position. So that's not a sleep well at night stock because I need to do something. I need to decide whether I'm going to do something or nothing, right? But I think, let me just give some thoughts. Microsoft Corp to me is a sleep well at night stock. There's a lot going on at Microsoft. I mean, you all saw their Azure report. I mean, it's really good. They've got a lot going on in their business model, but their management team is knocking it out of the park as well. So to me, Microsoft is a sleep well at night stock. So if I had to pick one out of my entire portfolio, I think it'd be Microsoft would be my sleep well at night stock. So great question, Pat. I appreciate that. And Lucas, yeah, sleep well at night. Oh, I get it now. It's an alliteration. So sorry, I didn't pick up on that. So I'll know next time. So next time you ask me, I'll know what a swan is. All right. Oh, wow. We got another one. Phil letting me know. Anthony, hey, Kevin, glad to catch the live. Started investing last April and have committed to 1K per week since I started. Would you recommend DCA or build cash and buy bigger during dips? That's a great question. I think for me, since you just started, I would recommend DCA personally. And that's what I did when I was, coming up in the investing world. And a lot of times we don't want to time the market. And what we mean by that is, there's a lot of things that can impact a stock and a lot of things that can impact the market. And we never really know when they're going to happen. And they can go both ways. But I will tell you this, that most big ticket items happen off hours. So you will not catch big swings by being agile, right? By trying to buy the dips. My suggestion would be I would DCA in and then just kind of go from there. Those are my thoughts. Suzuki Man, welcome to the live stream, my friend. I always sleep well at night. It doesn't matter what stocks he has. So that's awesome. Ex-dividend, he said, I was talking about the initial size position you make, DCA into it. Okay, I thought you were going somewhere else, my friend, but hey, it's all good. So David Arnold, I don't know if I've seen your name before. How about your thoughts on Cube stock? So Cube is a real estate investment trust, and since I've left this screen up here, I might as well do some work, right? So let's go first to simply Safe Dividends. Let's look up Cube, CUBE, Cube Smart. It's a self-storage REIT, and it has got a dividend safety score of 61. Dividend yield in the 5.46% range. It has a higher payout ratio, but that's normal in REITs. This is an adjusted FFO payout ratio, and I would say this is actually pretty low for most REITs. And I guess the next 12 months, they must be doing something, must be investing in something, because they are saying that the free cash flow payout ratio is going to be 352%. So I would want to dive into that and see what it is that they're purchasing. Their earnings are pretty consistent. So it tells me that their operating cash flow is probably not the issue. It's probably more their um, capital expenditures. So I would want to look and see what's driving that. And so it may be a very good thing. I would just want to know what that is. Let me look further down here. And as you know, on REITs and utilities, BDCs, business development companies, it is not unusual to see them issuing shares. So don't get alarmed when you see these companies issuing shares. I think that's fine. Look at this sales. The sales are growing fast. The return on invested capital is increasing. That's a very good sign. Let's look at their debt. Their interest coverage is going way up as well. So, you know, a lot of good things going on with CubeSmart. Let's go to Morningstar. Take a look at the intrinsic value of that. And you know, I tend to use Morningstar a lot for intrinsic value, but there are times that they use a mathematical equation, an algorithm to calculate it, and this is one of those times. And so I try to kind of validate somewhere else when I encounter this. But you see this Q, that Q means that it is you know, some kind of algorithm that they're using to calculate the fair value. I don't trust these a lot, so let's switch over to let's go to alpha spread, which is another. Let me try to find it here. We'll switch over to alpha spread and look at CUBE and see what they say. They say the intrinsic value is 4286, the DCF value is 2611, and the relative value is 59.62. If you're not sure what that means, they use DCF as what I would call an absolute value. There are two ways of determining valuation. One is an absolute calculation, and one is a relative calculation. And I know this is extremely exciting, but stay with me for a second. It does matter. An absolute calculation would be something that really calculates from the ground up. So DCF is discounted cash flows, looks into the future, calculates cash flows every year, discounts those values back to today's dollars, and says, hey, this is what the value is for that company. So I consider it like a bottoms up calculation. The relative view looks at metrics that are relative to others in their industry, like price earnings ratio, for instance, price to sales ratio. It'll take ratios like that and then calculate a relative value. And then what alpha spread does is it averages those two together. So, and so what they've done here is they said, hey, it's a $42.86 value. So we'll switch back over here to Morningstar. Their current price is 36. So it looks like they're a bit of a discount to me. So I think they're good. Yeah, I don't have any other issues. I would just want to know what are they doing with their free cash flow over the next 12 months. It's going to shoot that percentage up to 352%. That would be the only question, I think, in my mind. It looks like a really good stock from my perspective. All right. I don't know how far behind I am, but looks like I need to catch up a bit. So what's my favorite high yield ETF, 4% plus? That's a great question. I have two. Let me think. I have three ETFs in my portfolio. One is its ticker is DLR, and I don't know why I always forget their name, but we're going to go and look this up because that's not fair for me to not remember the name. It is DLR. Which is Digital Realty Trust. I like Digital Realty Trust a lot. It has gone up significantly, so I'm not really sure what their current yield is. Let me pull it up in Simply Safe here. So DLR is 3.77. So that's outside the bandwidth. So that's one of my three. The other one is Realty Income, which has a 6.09%. That's not my favorite, though. My favorite is actually KRC, which is Kilroy Realty. It has a 60 dividend safety score, a dividend yield of 6.91. So that's kind of my favorite at the moment. That could change tomorrow, but at the moment, that's mine. Let's see, Belkis. Belkis, I don't know if I've seen your name before. Welcome to the broadcast. Are you buying the Yield Max and Defiant stocks? I am not. So, you know, maybe I can look into those a little bit more, but I don't invest in either of those. Lucas, EL seems cheap, but I suppose, like you said, as long as you understand the stock. Exactly. That is the point of this, right? It is, there was a quote that I really liked, you know, when people were talking about valuation. And one of those is you really have to know the why around why it's valued, right? And the why has to not necessarily do with the past, but the future. The only way to understand the future is to get in there, dig in, understand the management team, understand their strategy, and see what it is about the future that's driving growth and prosperity for that company. Oh, my buddy, Russ Knopf from Dapper Dividends. Can you please give me safety scores, Morningstar moats, and delve into free cash flow scores for PG, KO, PEP? Okay, I don't think that's going to happen, my friend, but you know, maybe next time I'll get a spreadsheet prepared for you. But appreciate the question, though. Lucas, I'm not sure what's concerning. Oh, AEL probably. So, yeah, he's smiling at Russ, my friend Russ. Yeah, that's great. Russ, I appreciate that. That really lightens the mood a bit. And yeah, it is. I appreciate that, buddy. It is great to see me live. And, you know, hey, I'm learning. I'm struggling through this whole thing, but I really appreciate you guys staying with me on it. So, oh yeah, Dan the man, Dan Weston, Kevin is live now. So absolutely, my friend, I'm glad you were able to join. Tutomi is here, and he says hello to everybody. So Tutomi asked a great question. Do we start a new position in RTX? And before I answer that, I'm going to take a little drink, but I'm going to get rid of all that stuff. So RTX had some issues, and you know, it had to do with some paint related to some engines that they had manufactured, caused their stock price to go down. And I bought some actually around 73.89, or you know, just below $74. And now I wish I'd bought more, because I think it's up around 83. Is it a good time to start a new position? I think so. Will it go down? I'm not really sure. Will it go up from here? I'm not really sure about that either. But I do believe it is in a fair value range. So if you're looking at the long term and you're wondering if this is a good time from a fair value perspective, I would say yeah. And I think it's a great company. It's a company that's a little different than any of the other companies in my portfolio. It has a bit of a blend between, you know, construction and defense. So, you know, when I think about that, it gives me a little bit of an interesting twist in my allocation in my portfolio. But I like RTX. I like what I've seen from them. They've had a crisis, and I like the way that their management team has handled that. So, you know, is it the right time? Not really sure. It is, I believe, at fair value. But hey, you know, good luck with that. I'm going to wait and see if the price comes down a little bit more before I add any more shares. That's just me personally. Hey, Kevin, do you have, this is John J. John, I appreciate you joining. I didn't see you earlier. So, Kevin, do you have any concern over 10 to 15 years for the market downturn coming and dividend cuts to possible coming? Since you're retired, like to stay that way? Question mark. So I think what he's asking is, am I concerned over the next 10 to 15 years that this market is going to create problems for the stock market and companies in general, to where they're not going to be able to pay dividends in the future? And is that, concerning to me, since I'm retired and do actually spend some of my dividends? I am not concerned about that. And, maybe it's, maybe I'm just being naive, but I'm not concerned about that. I look back at the history of dividend paying companies, and it is during times like this that the return that we get from the stock market is from dividends. So if you were to go back and look at, let's say, from 1920 to 2020, and you look at some of the time periods like World War II, right? And some of the deep recessions that we've had as a country, the great financial crisis, you look at the dot-com bubble, and you look at where the returns actually came from. They came from dividends. They didn't come from share price increases. So I think over the next 10 to 15 years, I think dividends are going to be around, and they're going to be strong. And so I'm looking forward to the future. So also, no Japan-like stock market. I think I'm not really sure what that means, but I know that I saw that Japan's interest rates flipped today. So that might be what you're referring to. Let's see. Oh, Billy Johnson, I appreciate you joining, my friend. You are in, I don't know if you're still in Thailand or if you've gone back to the Philippines, but welcome to the live stream, and I appreciate you joining. Let's see. Looks like I'm getting some repeats here, but let's go back to John. Market was up today, mostly REITs and BDCs. Interesting. Yes, I agree. It's all interesting. And I think that's why we just stay invested, because sometimes it moves in ways that we never really imagined, right? Let's see. Did you buy any more WHT? I think that might be WHR. Oh yeah, there's the next one. WHR. That is Whirlpool, and that's a great question. My thoughts on Whirlpool is that I did not buy any more. I'm waiting on Whirlpool, and the reason I'm waiting is because I need to see something from them. I'm not buying them because of their price at this point. I'm buying them because I want to see the management team executing a strategy that's going to get them back to a winning position. I haven't seen that yet. It doesn't mean I'm selling any, but I'm not buying any more at this point because I need to see something from the management team. That's a great question, though. Let's see. Dung, he says, what stocks would you buy and hold forever if you can have 5 include dividend and non-dividend? Wow, that's a great question. I mean, one of them is Microsoft. It is a buy and hold forever, I believe. I'm not as big a fan of Apple. I do own, a big percentage of my portfolio, like 28%, is in VOO. So I have a lot of exposure to Apple because of its exposure inside VOO, but I no longer own any individual shares of that. So I would say Microsoft is number one. I think Johnson & Johnson is struggling right now, but I do believe it is a long-term, buy and hold forever stock. So you get 2. Can't think of 5 off the top of my head. Russ. Yes, sir. Let's see. Any thoughts on NEE? And I think that's Next Era Energy. They've got a lot of different, let me flip back over here. They've got a lot of different entities. I know there's NEE and NEP. Let's pull up NEE, Next Era Energy. Very safe. They've got a dividend yield of 3.17. They have come down in price recently, but let's look at some of their other metrics first. We'll see that they have a payout ratio that's very good. Oh, and this is a great time because NextEra Energy is a utility, and it is important to understand that utilities will typically have negative free cash flow payout ratios. And as you can see, that is certainly the case with NEE. Would not be concerned about that at all. As you know, I came from the utility industry, and it's just a different business model that requires investment. And because of that, they are investing typically more than the cash flow that they bring into the company. Earnings per share, you see, is growing. They're up and to the right. So it is it's actually looking pretty good to me. Let's go to Morningstar. I'll just pull up NEE really quick. NextEra, they have a narrow moat, which is typical, and an exemplary capital allocation rating. They have, since they're 28% discount. So here's what I think is going on. I think the interest rates are really pushing some people away from utilities, because utilities do borrow a lot of money, and because they've got to invest a lot of money. So they borrow a lot of money, and these interest rates are really going to hurt them. They may have a lot of fixed debt, but they are continually borrowing, which causes them to be in this market of higher interest debt. So I think, we have some of that going on. So there's some people who are afraid of utilities. I think it depends on whether you see the Fed lowering interest rates soon or later. If it's later, I think I would wait. If it's sooner, it might be a great time to pick up some utilities. So that would be my suggestion on that, on NEE. A great company. They've got a lot going on. And so I certainly wouldn't be afraid of the company. I just don't know if now is the right time. We need to start a GoFundMe for get Russ a new computer. I agree with that. Thanks, Greg, for bringing that up. He does need a new computer. I might actually send him one, but I don't know his address. If I knew his address, I might send him one. All right. This is 1929. I'm not sure. A-Bone Pickup. So any input on Main? I love Main Street Capital Corp. It is a business development company. They have a lot going on. They are solid in terms of their strategy. They not only are they loaning money to new businesses, they are pulling alongside them and helping them strategically grow that business. And they are being very successful at that. So I'm a big fan of Main Street Capital. I do own a few shares of them. I'm kind of waiting for them to come below 40, for some period of time. And I know they have been here recently, but I was buying other things at the time. So I do like Maine a lot. Miguel, Kevin, what are your thoughts on concentration? I think it's important that we concentrate on things. I don't think that's what you're talking about, though. I think, and I think you mean maybe diversification or being overly concentrated in a certain area. I think diversification is really important, but you can get there by buying ETFs and things like that to diversify your portfolio. So I'm not too concerned about getting there. I think, it works pretty well. All right, let's move along here. I need to get caught up. I am pretty caught up. So this is Clayton. Clayton, welcome to the broadcast, my friend. What are your thoughts on Realty Income, purchase of Spirit Realty Capital? That's a great question. I'm not a huge fan of Realty Income's last two acquisitions. This last one was Spirit Realty. I think it's a fine purchase for them. But it's almost exactly the same as what Realty Income is. So my concern with that, I know they say that it's accretive 2.5%, but my concern is that they have bought a company that just makes them bigger. It doesn't make them better. And so, usually what I look for in M&A is for synergy. That would be, 1 + 1 = more than 2. I'm not really sure we got that with the Realty Income and Spirit merger, I think we really got 1 + 1 = 2. So, it's we'll just have to wait and see. But I'm not real pleased with that merger. I mean, it's not terrible either. It's not a bad merger. It's just not something that I think is going to take them to the next level. Okay, 1929. Just buy Maine anytime it's under 40. It's a great for monthly income. You're absolutely right, man. I agree with that 100%. Miguel, if you had to choose 5 stocks and hold them forever, I think we've already seen that. Wonder why I'm getting multiple of the same ones. It's tough to make predictions, especially about the future. Yogi Berra. Fuzzy, that is exactly right. And it's hard to predict the weather unless it's easy to predict the weather unless it changes. So Thomas, hello from Alabama. Roll Tide. They did have a great game against LSU the other day. So congrats for that. Thoughts on ARCC? That is, I think, Ares Capital. Negligible growth, but 10% dividend. Let me pull that up real quick and take a look at that. I don't have any shares of them, so I typically don't look at their earnings and stuff. But yeah, Ares Capital, dividend safety score 59. They're at a yield of 9.83%. Here's what I always say about Ares Capital. If I were to invest in 2 BDCs, it would be Main Street Capital Corp and Ares Capital. But I don't. I only invest in one, and that is Main Street Capital Corp. So it is a fine BDC, but it's not one that it has very low dividend growth. And so it's not one that I'm particularly interested in. So those are my thoughts. I don't know if that's helpful thoughts, but those are my thoughts. All right. Okay. Here's a great question from Thomas. Thoughts on NWBI? It's a regional bank. I'm not familiar with it, so let me pull it up. NWBI, Northwest Bank Shares. It's a 50 borderline safe dividend score. 7.27% dividend yields, pretty high in the dividend yield realm. Let's see what they're looking at. Their payout ratio is actually pretty high. It would be a little bit of a concern, and their cash payout ratio is also a bit high. There's some things about banks though that like their tier 1 capital requirements, and since it's a regional bank, they may not have that to deal with. But there's some things that are special about banks that wouldn't be in this particular app. Yeah. I don't know. I would be a little bit concerned about them. I wouldn't want to chase yield with them. But, it'd be something that I would want to really dig in more about the management team and stuff like that. So I don't have any it's not NWBI is not a stock I would go out and buy tomorrow if it were me. Oh, Tutomi, thanks for the reminder. Everybody like the video. We are coming close to an hour. I think we're going to go an hour. We might do just a couple minutes more than that, but I'm going to let everybody get back to their evening. So what's your thoughts on ARB? This is Craig. So Craig, welcome to the broadcast. I haven't seen you tonight, so welcome. Let's see. Let's look at ARB, and it's not coming to me off the top of my head. Wow. It's because it's Alt Shares Merger Arbitrage ETF. It's an ETF that, man, I would need to spend. It looks like it's very new. It's only maybe a year or two old. It's got an dividend yield of 4.08. So not much information on them. I just don't know. I've not studied them. So I'm going to have to take a pass on that one, my friend, because I don't see much information on them. So, hopefully they're good. I just don't know. There's just not enough info. Miguel, Which consumer goods stock would you choose to hold for 10 years if the stock market was closed for that time period? Oh gosh, consumer goods. So that would be, I think one that I tend to like and I owned for a while and then sold it because the consumer goods stuff is just way up would be Kimberly Clark. I think that is a pretty good stock, but I haven't looked at it lately, so don't hold me to that. But if all of that happened, I'm not sure I would really be concerned about which consumer goods stock I was holding. But in this scenario, I would say Kimberly Clark. So, hey Kevin, this is Captain Suburbia. Welcome to the show, Captain Suburbia. Hey Kevin, looks like I am late to the party, but hope you are having a nice stream. Dude, this has been a lot of fun. I have been really enjoying this. And, when I was getting ready for this, I was actually kind of nervous because I was like, what am I going to talk about for an hour? But man, you guys deliver. You're sharing, questions and stuff like that. So it's great, man. I'm loving it. So I appreciate that. I think we're going to wrap it up here. We're about a minute over our hour timeline, but I appreciate you guys joining. And if you would, don't forget to like the video, and really appreciate you guys joining tonight for my second live broadcast. And we're going to have another one next Monday night, 8 o'clock Central, 9 o'clock Eastern. So be there or be square. I'll see you then.